direct lending into China is really nascent at this point. So that's not where we're focusing as much as the other parts of the region.
Okay. So in terms of the legal structure, how much does that matter to you, given the fact that that's kind of key to recoveries?
Well, that's why you see a lot of the direct lending in Asia are in systems like Australia, where they have more westernized forms of bankruptcy. China's still evolving. Now, there's a lot of firms that say we can go in there and play in the MPL game and things like that, which is fine, but you're dealing with if you will, a bankruptcy legal system that's less proven.
How important is a trade deal to determine what you do in Asia?
Trade deals will impact the economy. They will impact, if you will, how we do business. In some ways, I think this trade war has made it somewhat easier to get on the mainland for firms like ourselves.
How so?
Well, you know, a lot of the process we went through in the last couple of years to be licensed, frankly, went better than we thought. So maybe there's a little bit of China needs to open its markets, and where are they comfortable opening their markets? You know, we were benefiting from that over the last 2 years. Now, broadly, China needs to open their markets even more. And the trade war makes that harder because of this tit-for-tat mentality between the U.S. and China.
How concerned are you about the increase in non-performing loans, as you talk about, and the idea that China is providing net less liquidity to its companies and banks?
You know, that's a very good question. At the end of the day, it's very hard to say how bad is the NPL situation in China. Certainly, if it became disastrous and caused China's growth to slow much faster than predicted, that could be a problem for the global economy. We don't see that right now. You know, we see sort of managed growth in China for the foreseeable future, and really globally, global growth being anchored by the U.S.
Is there any region you're avoiding right now?
I don't think we avoid a whole region. Now, we will avoid going into asset classes or making investments where we're uncertain about the sovereignty. Our emerging markets teams often look at that, and they're comfortable in certain countries at certain times, and others they back away if there's uncertainty.
We've heard a lot of companies, asset managers, say that they expect their private markets presences to grow dramatically. A number saying that they plan to even double their assets over the next 5 years or so. Where are you on that?
Well, in terms of private assets, of our $336 billion, we have around $90 billion in private debt assets and private equity assets. So I don't look at it as we're new to the game. We've been investing in real estate infrastructure, private placements, and for decades. So for us, it's really the continuing growth and expanding our resources into areas where we think there's opportunity, infrastructure debt, infrastructure equity, continue to grow our resources there as an example.
All right, so you don't have necessarily a target or an expectation as to how much the assets will grow?
We really look at it as we try to outpace the market by about 4 or 5% per year in terms of flows. And if we're generating net positive flow of 4 or 5% to the market, we're going to be in good shape as a firm.
So the big story of the past 5 to 10 years has been fee reductions across the board. And we've seen this in public markets and to some degree on the hedge fund side when it comes to the 2 and 20 model. Where do you see it going in private debt, private equity, and infrastructure?
Fees in a low rate, low return environment, fees will continue to shrink. And in fact, people talk about, well, why did direct lending come because of the bank's regulations? That's part of it. But part of it is the cost of originating that asset. We have clients who want that asset. We can go in there without armies of people building relationships with private equity and do deals. So it's that value chain between the issuer capital and the investor. You have to squeeze those fees because you're right, 2 and 20 doesn't work. Fees have to come down in every asset class.